All right, good afternoon, everyone. Hope you're doing well, and hopefully you had a good experience with the US inflation data that we had this morning. Rarely do we get the inflation data and then the FOMC on the same day. So double whammy, but we got plenty of time now for the Fed to go through that. Remember, if you did like the video earlier on in the morning, don't forget to give us a like, share the video, subscribe to the channel, and get the word out there. But let's get into the FOMC and then what to expect. So what is it? It's a meeting that happens roughly every 6 weeks over a 2-day period where the central bank sets policy and the federal funds target range. And it's also the rate that banks charge each other to borrow or lend excess reserves overnight. Then why is it important? Well, it causes volatile moves within the markets and affects the wider economy, and they may also influence other central banks to follow in the rate path. That's not so true as of now, with a couple of the actually three of the central banks taking a rate cut decision before the Federal Reserve has done, with the Bank of Canada, the Swiss, the S&B, and also the ECB as well. So a little bit, so majority for other central banks then can have an effect on what they do. The advanced economies have a bit more leeway and a bit better practice with setting the rate. All right, so if we carry on, so how does it affect the markets? So with currency, if the central bank decides to raise interest rates or is seen as more hawkish than expected, then that can lead to an increase in the value of the currency, or more of a bullish effect that can occur. And if we take a look at the stock indexes and the stock market, usually if the central bank is more dovish than expected, that can provide a move towards the upside and a bullish reaction. But if the central bank on the flip side is more hawkish, then you can get the opposite happening instead, with stock indexes taking a hit. And especially with the summary of economic projections, we get extra bit of data from the Federal Reserve, which then provides a better idea of which direction then the Federal Reserve is going into, and in turn then provides a clearer market reaction to the data that we get from the Federal Reserve. But of course, there is always a risk with the interest rate decisions, because of how volatile it can be and the expectations then that come from the central bank in the future. And on top of that, you have the press conference later on too. So that could also muddle things for the markets and switch up sentiment at the same time. Mr. Borwick said, test. Oh no, we're getting some spam guys in here. Hey MM, I know you're not spam. All right, so let's carry on then. Anyway, so for the bond market, bond yields, it's if the central, same like with the currency, if the central bank is more hawkish than expected, then you'd expect a rise in bond yields in anticipation that the central bank isn't going to be as accommodating to the economy as soon or sooner rather than later than what economists and traders may have expected or may have wanted to happen. So what we need to just be aware of is that the bond futures then, for the bond prices, they will of course go down as bond prices will go up. All right, so where is the economy at the moment? First of all, we have GDP Q1 with a second estimate at 1.3% compared to 3.4%. Then inflation, of course, we had this morning, ticked down 3.3% compared to 3.4%. Core inflation at 3.4% compared to 3.6% compared to the prior. PC price index unchanged at 2.7, unchanged at 2.8 for the core PC price index year on year. Consumer spending at 0.2% compared to 0.7%. Non-farm payrolls at 272k compared to 165. ISM manufacturing at 48.7 compared to 49.2. US ISM Services PMI 53.8 compared to 49.4. Then with the UMich, University of Michigan sentiment came in at 69.1 compared to 67.4. 1 year inflation expectations did decline to 3.3% compared to 3.5%. 5 year inflation at 3% compared to 3.12%. Employment cost at 1.2% compared to 0.9%. And then if we look to the previous FOMC summary, then that had occurred on May 1st. First, we'll go through what happened on March 20th, which was when we would have got the last summary of economic projections. So policymakers still projected 3 US rate cuts this year, even as inflation remains elevated. The Fed's updated quarterly economic projections show the Personal Consumption Expenditures Price Index, or the PC Price Index, excluding food and energy, the core data, rising at 2.6% rate by the year end compared to 2.4%. New Policy View also raised the outlook for the US economy, and policymakers now see growth at 2.1% this year compared to 1.4% projected in December. Inflation has eased over the past year but remains elevated. So that was the March meeting. Now, the latest FOMC that we've received from them, just to kind of provide a bit of a comparison, although that had the summary of economic projections. So in this one, they said that the risks to achieving employment and inflation goals have moved toward better balance over the past year, as opposed to are moving into a better balance in the March policy statement. The Fed will slow the decline of balance sheet by cutting Treasury redemption cap to $25 billion per month from $60 billion starting in June 1st. The Fed does not expect it will be appropriate to cut rates until it has gained greater confidence inflation is moving sustainably towards 2%. That's the key point there, and that's what's been echoed later on from then on by some central bank members from the Fed, that they're not entirely confident yet that inflation is making a sustainable move or towards the downside, and the disinflation process is not, in its full throw swings, or it's not getting there fast enough. Let's put it that way, for the central bank to then begin cutting interest rates. They also said that economic activity continues to expand at a solid pace, and job gains have remained strong, and unemployment rate has remained low. Inflation has eased over the past year, but remains elevated. All right, so the next point then, if we look at the Fed minutes, or summary of that on May 22nd, participants at the meeting assessed it would take longer than previously anticipated to gain greater confidence in inflation moving sustainably to the 2% target. Now, off of the back of that comment, the dollar had rose and the S&P 500 had seen weakness off of the back of that comment there. Various participants mentioned willingness to tighten policy further, and should risks to outlook materialize and make such actions appropriate. Also, many participants commented on their uncertainty about the degree of policy restrictiveness. So when I was talking about the lack of confidence then from the central bank in inflation moving towards the 2% goal, that was more or less, that had come out in the open with the Fed meeting minutes. So the expectation then for the Federal Reserve, if it is 2 rate cuts that are to be expected, or if they do show in their dot plot that they still expect 3 interest rate cuts this year, which would be a positive bit of news for the stock indexes, because of how the data. Well, okay, last week NFP was stronger than expected, and CPI today was weaker than expected, which provided that bit of relief. So the mixed data then provides a picture that is a bit mixed as to what the Federal Reserve is going to do or likely to do. So this summary of economic projections will then kind of cement what the central bank could do later on in the future, and give that clarity that the markets and economists would then need. So if they do decide to stick, let's say if they do say, okay, inflation isn't easing as quick as we thought, but we still see a couple of rate cuts this year, rather than on the flip side, which would be a bad scenario for the stock indexes if they see no cuts at this meeting. Oh, and in the summary of economic projections and in the dot plots, if that were to occur. That, of course, would strip out the expectation that the central bank is at all dovish and is actually being more hawkish than what the markets had expected. An extreme scenario would be if they don't see a rate cut in early 2025. Very extreme. We're getting closer to the 2% goal. We're only about a point. We're only about 1% and 1%, 1.3% away for the year on year. So it wouldn't make sense for them to go to anything later than early 2025. That'd be a bit too hawkish if that were the expectation. If that were to occur, though, then of course that would really hit the stock indexes and provide a boon to the dollar then to move towards the upside. Then for the other central banks, if the central bank is not looking to cut interest rates this year, or the expectation is they're not looking to cut interest rates, then the other central banks that have cut their rates already, although the influence isn't too great or very great on the other advanced economies, there still will be consideration as to what they might need to do so as to not devalue their own currency against the dollar if it's much stronger than expected. Or the US will have to take into consideration that their currency isn't too strong against other currencies that are weaker, and then making trade more expensive for those other nations to trade with the US compared with the other nations that have cut their rates to trade with each other. So Fed members then in their comments, we had Fed's Bostic said that he would not be surprised. It would not surprise me if it took longer to get to 2% inflation in the US than anywhere else. That was on May 23rd. Fed's Bostic again on May 30th says, I don't think a rate hike will be required to reach the 2% goal. I expect to reach inflation goal without unemployment jump. Goolsbee said that housing inflation is well elevated compared to pre-COVID levels and will be hard to get to 2% unless that changes. We don't need to be exactly at 2% to cut rates, says Williams, and the Fed policy is well positioned to get inflation back to 2%. And Kashkari says, I won't pencil in more than 2 cuts for 2024, and I don't think anyone has taken rate increases off the table. So, summary then of the comments from the Fed members so far is that they're not entirely confident and that the potential for 2 rate cuts, it's there, considering the weaker data that we had from CPI today. And that was my personal opinion, that we could see 2 rate cuts happening, one in September and then one in December. But of course, we have to wait to see what the Fed actually says, and maybe they only see 1 rate cut happening this year. But again, those are the comments from the central bank members so far. So investment bank views then. So you had MUFG that said that US rate market is now pricing in only 2 basis points of cuts by July, virtually seeing no change, and 37 basis points of cuts by the end of this year. Our call for the first Fed rate cut is in September. That has fallen to around a 50-50 probability. We already expect the Fed to signal a delay to plans to begin cutting rates, given the lack of progress so far this year for inflation to fall back to their 2% target. So that from MUFG would obviously have a slight change then, maybe in favor of a September rate cut, even more so than compared to a 50-50. Morgan Stanley, so the FOMC statement describes progress on inflation as slowed rather than stalled. The summary of economic projections will likely show a shift to 2 cuts this year instead of 3, marking to market for stronger inflation data in the first quarter. JP Morgan said that we believe the Fed will almost certainly remain on hold this week and move its projections in offsetting directions. 2024 GDP growth is likely to be revised down to around 1.5%. Core PCE increases revised up to 2.8%. And most likely this year's projections for 3 rate cuts will be trimmed. The committee will likely be finally divided between 1 and 2 cuts this year. And we believe a dovish-leaning chair likely tips the balance towards 2. And our team shifted its view this week to anticipate only 1 ease this year coming in November. On the 11th of June, you had ING said that the Fed accepts monetary policy as restrictive, but lingering inflation and strong job numbers mean it will indicate it's prepared to wait longer before seriously considering interest rate cuts. Of course, we had the stronger than expected non-farm payrolls data last Friday. The dot plot will be key, having signaled 325 basis point cuts in 2024 back in March. It could potentially go to just 1, and they're expecting 2. They also note that the dollar has ended lower on the day after the last 4 consecutive FOMC meetings, largely on the back of Powell's dovish rhetoric at the press conference. Just something to bear in mind when you're as how the markets have reacted to the press conference for Powell, and how he has been seen as dovish in the press conference. So that might change at this meeting here, maybe not, considering the inflation data that we had today was slightly lower than expected. But it could be up in the air that his press conference might be a little dovish, but the SEP could show that there may be 1 rate hike in the books, for the books instead, at the moment, rather than 2. They also said that they can't rule that they cannot rule out that happening again, given that market pricing of this year's Fed easing cycle remains on the low side of just 35 basis points at the moment. Now, this is from ING and their expectations for what the Fed will predict in its new forecast. So you see here with the current economic projections in the white, in the white rows, and the orange with ING's expectations. So first, let's look to the federal funds rate. So if they expect it to go to 4.9%, or to end up there at 4.9, compared to the previous 4.6, then all the other dates all the other years look the same. There's no change there. Now, if for whatever reason that the expectation then for interest rates is higher than let's say 5%, or if they do surprise the markets and go higher than 5.5, then of course that could then provide a significant upside move to the dollar, and we could see the S&P 500 taking a real big old hit in the market. That would be if the central bank was really hawkish, though, which is unlikely to happen. So something around 4.9 5% kind of makes sense if the central bank wants to look for less easing this year than what they had expected. What they expected last time around. Then for the inflation expectations, seeing it slightly tick up there. The unemployment rate not really gonna matter so much today, and neither the GDP expectations, because the focus is going to be on the federal funds rate. Where do they see it? Because then traders can then try and predict how many rate cuts are going to occur this year, and whether or not they're going to be back to back, or if there's going to be a cut and then a pause at a meeting, or not. And then the next point will be to focus on where they see inflation headed. So last time around, I believe, if I just bring up the ranges and deviations here. So let me just quickly bring it up here, so if you guys have a little look. So in the sentiment then, on March 20th, so they raised their GDP and inflation outlook, but they also kept they also kept the rate cut forecast, and they still saw 3 rate cuts this year. So this is how the markets had reacted last time round. And of course, if you're looking at this view here and you realize I have upgraded the look a bit better to make it easier to kind of read the data and how the markets have reacted as well. It's beautiful, isn't it? So you'd seen 61 ticks towards the upside on the S&P, the NQ, about 247 towards the upside on the initial market reaction. So again, this shows you the initial market reaction going to the wick of the candle. The figure in the black brackets shows you the market reaction 10 minutes after the release has occurred, going to the end of the candle. And then here in the blue brackets shows you the market reaction 30 minutes after the release has occurred for the economic release. Okay, so you get a nice idea as to how long then does the momentum last for an economic release in the markets. And here it was quite nice. It sustained its move towards the upside rather than kind of pulling back so much and then reversing its gains or losses for any of the assets. So then with the currency pairs, the biggest market reaction came from USD JPY. Usually has seen the biggest market reaction overall consistently in the past, so that's something to be aware of with the dollar CAD. And then if we're looking to the bond space, then with the 2-year bond futures, that consistently has the biggest market reaction because it's the shortest rate then traders could actually actively trade within the markets, and is more sensitive to the changes in the interest rate decision and what the central bank does. So the 2-year bond price, 2-year bond futures, seeing a bigger market reaction compared to the 30-year. And Bitcoin too had about 96 ticks up towards the upside on the Bitcoin futures. But then after about 30 minutes, it reversed that and was still up but by about 10 ticks. Okay. Well, nearly reversed it, should I say. All right, so sentiment last time then, if we're looking at what caused the market's moves, you had the rate statement was largely unchanged. The markets had already priced in a hawkish Fed. The only slight change was risks to achieving employment and inflation goals that have moved toward better balance over the past year, as opposed to are moving in better balance in the March policy statement. So traders saw Fed rate cuts most likely in November, and they saw a smaller chance of no Fed cut this year after the FOMC meeting. All right, so from here, it was a bit mixed last time round because usually you can see here, right, when you have the summary of economic projections, you get a better market reaction. So here, no SEP, SEP, cleaner market reaction. No SEP, it's a bit more muddled. SEP, cleaner. This one here, where we didn't have the SEP, SEP, cleaner. You get the picture because we had more data to look at from the Federal Reserve. So you get a better idea of what the Fed is looking to do rather than trying to have to look through the headlines and kind of guess and then see if it's priced in or not, or if it's not priced in, and then it's much easier to have a look at. So I won't say it's, go for it. It's it can be seen as a slightly easier trade when trying to understand what the Fed is doing. But of course, you guys all know that there are that the risks that trading a rate decision carries, because you don't know what could be said, what data could come out, because it could be the complete opposite or even better than what you would have anticipated then from the central bank. Okay, right, so that was the deviations last time round. Of course, if you want access to the ranges and deviations to be able to read through this is completely free, okay? So now, to get access to this, I'll just pop a link here. I'll just get it up again. All you've got to do is sign up to the MACROACE mailing list, and in that mailing list, that's the link there, by the way. So sign up to that, and then you get access to the MACROACE mailing list. You get access to the ranges and deviations in an email on Monday that I'll send. Okay, I send one email a week on a Monday, giving you a rundown of what to expect for the week ahead in the different sessions, a summary of anything of what's happened in the past, anything that's been important for you guys to know about. And then I'll give you the links to the live streams and also the deviations. Okay, so here is the an example of an email that I sent out. So an expectation then, and a bit of a summary of what had happened the last week, or what had happened the week before. If there's anything to look out for, the links to the deviations are there, and to the live streams. And then of course, it doesn't have a lot of detail, because in the live streams is where I give you guys the detail of what to look out for. So keep an eye on that. Click here for live streams links, because then of course you can get access to all of the live streams. I say that, but I also do put it out onto the Financial newsfeed. Basically, this is completely free, so you can sign up to it, have a little look, and also give us your feedback too on the information that we're putting out. Is it good? Is it not? What are the reasons for subscribing or not subscribing, and so on and so on. And just give us your feedback so we can improve. And we already have made, I think, some improvements. Some improvements we have yet to make. I know there is a market profile we did have one user asking about, but we have a lot of stuff in the pipeline, so it's taking a bit of time. Anyway, so let me get this out of the way. I remove this out of the way, and let's put that back. Okay. So anything above 4.9% will then provide a bullish reaction. Could then provide a bullish reaction to the dollar, and a bearish reaction for the stock indexes if the central bank is more hawkish than expected. Then what could also happen as well, if the central bank has a lower than expected economic projection compared to last time around. Let's say if they go below 4.5, then that means that there is, for some reason, there are more rate cuts that are then priced in, potentially, or more easing that is then expected to take hold, which wouldn't make sense considering how the Fed members have been talking about being unsure about the 2% target. I mean, we still got about 6 months or so. So, there is a possibility for that to occur. But then there's a lot of work for then the central bank to do, and then, a lot of holding on to your cracker nuts to then really take the reins and go for it. So anything lower than 4.5 would be a surprise in our eyes, if they expect, with the expectation for where they see the federal funds rate. All right. So if we carry on then what is the market, or was the market pricing? Of course, we had today's market pricing with the inflation data. So first of all, with May 22nd, post FOMC meeting, FOMC meeting minutes, short-term interest rate futures were down after the FOMC. Traders still betting on a September start to Fed rate cuts. May 31st, post PCE, short-term interest rate futures rise after PCE data as traders add to bets for Fed rate cuts, and traders firm up bets on Fed rate cuts in September and December after the CPI data. Then you had June 4th. So just for the PCE data there. So as I was saying, for June 5th, you also had the Fed to cut rates by 50 base points in 2024, according to 68 of 116 economists in the May poll, and with 28 saying 25 basis points, and 5 saying no cuts at all this year. Then June 7th, with post stronger than expected non-farm payrolls, Fed swaps no longer fully priced in a rate cut before December. Interest rate futures traders slash bets on September Fed rate cut and now give it a 55% chance versus 70% before the jobs data. And JP Morgan changes their first Fed rate cut view from November to November from July. And then with today, with the inflation data, you had US interest rate futures now imply 70% chance of a Fed rate cut by September. And also they price in bigger chance of Fed rate cuts happening this year. So that inflation data, quite important then very important for the expectation of what the Federal Reserve is going to do, especially that we get the summary of economic projections on the same day. So it will act as like a confirmation then for traders. Doesn't give us room to breathe in trying to trade the markets, but it is what it is. You got the double whammy, you wanted it, and now we get it. But at least you get it over and done with, I guess. So you don't have to wait in anticipation for the central bank to to make their decision. Okay, so let's go to the next point. So this is the last rate decision that we had, and on May 1st. It's about a couple of things before that data was released. So you see the markets taking their time a little bit before they make a decision. You might see some people trying to jump in beforehand because they might be trying to predict which way the market is going to go. Please don't be like those guys. Please be careful. I mean, you guys know to be careful anyway, but be aware then of that risk of people trying to jump in to try and predict which way it's going to go without having read the statements or understood it. So here the market reaction was a little less, it was a little more muted compared to what we had seen in the past. Of course, we didn't have the summary of economic projections. So the market moves were a bit, weren't as fast or sharp then for the FOMC. Okay, so took a trade there. The momentum wasn't that strong, but it did take that opportunity there to take it on the NQ. Let's kind of skip forward, let's get it out of the way. See what else we had. Here's how the rest of the markets are reacted to. So you can see with the 2-year bond futures, did see the move towards the upside, of course, with that wick, big old wick there. Something to be aware of. The dollar yen, similarly there as well. And the S&P though, but you can tell that it wasn't really anything that was crazy market moving, or there wasn't a lot of volatility that really was there, because there wasn't too much to really garner from it, and markets were taking it as like okay, it's happened, and let's carry on and move on. And then if we kind of skip ahead a bit forward and see where we had ended up. Okay, so yeah, it's just kind of not really a lot that was going on. Although the initial market reaction could have been a nice little play, but it's not really enough. And you can see, even just visually, when you're looking at the other candles, right? Usually when you see a big market reaction to the data, or to a Fed, or to a central bank decision, whatever it is, that you kind of see the candles, you can see on the dollar yen at around, from around 1 p.m. onwards, being quite flat and small. So here, looking at the S&P back there in the bottom left, it doesn't really show that much had actually occurred. All right, so that was the video last time around. Let's get out of that. Okay, And so let's get set up on the financial newsfeed. Of course, if you did miss the inflation data, actually that's quite good for WTI. From build, we're actually starting to get market reactions. So that's a good point to know. Maybe it's a release then that we can actually start looking at again. Because, I mean, it has been put off quite a while with considering how the economy's fared and the conflicts that we've had. But last time around, we had seen that was, look at that. Beautiful, good old market reaction. Not as strong as what we had seen previously. I think a couple of months before that in April, we had seen about 954. Let me just get ticks. Yeah, 954 ticks towards the downside in April 10th off of stronger than expected CPI data in the US. Okay, so I'll get TICKSTRIKE up and running in a little bit, but here we are with the Financial News feed. If you've never come across Financial Juice or a live voice and text service, then Financial Juice, what it does is it provides you with what's going on within the markets live and in real time via voice and text. And it covers global news, what central bankers are saying, so you can keep on top of that and see if there's a change in sentiment. Particularly with the releases that we had this morning, the shift in sentiment then for traders who are pricing in, that then gives you more knowledge. That's the key thing. The more you know about why something is happening, the more power that you have to then trade within the markets. Particularly if you're a day trader, you're looking for any sort of opportunity that could come across your way. It doesn't matter if the market's going up or down. You just want to jump in and go, bam, take it. So that's another key point about having a live voice and text service is then you stay ahead of what other traders who don't have a live voice and text service. You stay ahead of them. Okay, yeah, you can trade how the markets are moving, but why is it moving that way? I don't know. To make money. But if you do know why it's moving that way, then you can have a better understanding and then make better decisions then when it comes to trading the markets and economic releases. So that's the key point about having a live voice and text service, is having that knowledge, having that edge, being on the bleeding edge of news, live and in real time via voice and text. So here we have our news feed in the center of the text headlines. We have our economic calendar for the day ahead and also the week ahead of economic releases to expect. Here in the center or here on the right hand side, you have your voice news to be able to listen into us live and in real time, speaking on the microphone, telling you or giving you the headlines that are coming through and keeping up to date what's going on in the markets if there is something of importance. So getting rid of a lot of the weeds then that don't really need to be there, and give you a clearer picture of what's going on. We can have a look at the dot plots, the previous and current dot plot. I mean, I'll bring that up in shortly. Actually, I'll put it up somewhere. Okay, so there we are. Financial Juice, a live, real-time voice and text service that provides you with up-to-date market moving news, live and in real time, and keeping you posted about what's going on in the markets. Okay, so if I grab you the link here, we have currently at the moment we have a promo offer for Financial Juice. So instead of paying $1,100 for a year's worth of Financial Juice, something happened with my mic there. We're all back. Or should be back. So as I was saying, instead of paying $1,100 for Financial Juice for a year's worth of the service, then all you got to do, you can get a juicy 92% discount and get FJ for $99 for a year instead. So juicy 92 is the promo code, and you get a 92% discount from that package there. Okay, so I'll put in the link here. But first, before you guys do that, if you're new to Financial Juice and you've never come across this before, sign up to Financial Juice. Create an account first before you think of paying for the service. Because if you don't create an account, then it's going to be hard to set you up for Financial Juice, and then you're like, hey, where's my pro account, son? So yeah, get your account set up, verify your account through your email, and then when you're ready, then you can click on this little button, which is in the top left here. Okay, there'll be a button that says GoPro, where I'm currently clicking around there. Sorry if that's kind of this shouldn't be too bad. If anyone's getting any issues with that. Okay, yeah, click there, and then when you're ready, put in your Juicy92 promo code, and then you get Financial Juice for $99 for the year rather than $1,100. Okay, so that's Financial Juice there, and the link takes you to the light version of Financial Juice, so to get your account initially set up. Now, the light version is free, but there is a delay, and there are adverts that do play on there. But if it's the first time coming across a live voice and text service, have a little play, get confident with it. Then once you're confident with it and you're ready to go with the Financial Juice Pro version, then bing. Then you can sign up to the Financial Juice Pro version and get your Juicy92 discount. Okay, so that's there. We've got about 3 minutes left. 3 minutes. And so I'm just going to get myself set up with our trade setup here. So, of course, as I said, with the data that we get today, then you're going to get, of course, a clearer picture and a potentially much cleaner market reaction than you would without the summary of economic projections. Okay? Because of course we've been given more data to look out for, and there's more information to be had. The more information we get from the Fed, the better it is for then to make your own trading decision. Otherwise, you're kind of going in blind. You're putting your hand in, have you guys seen Hot Shots Part 2, where they do the kickboxer style skit? They put their hand in like honey, and then put in like jelly beans or sprinkles. Well, think of it as putting your hand in, in an unknown quantity of whatever it could be, nails or glass or maybe snakes. Imagine punching someone with a rattlesnake on your fist. Yeah, probably not a good idea. Anyway, we got about a minute and a half left. Let's get everything else set up here. Let's see, we've got dollar yen, gold at the top there, top right, S&P bottom left. Let's also get 2-year bond prices for 2-year note futures are burning. Okay, there we go. What else am I missing? I think that should be everything. Ah, yes, that was it. Okay, we've got about 30 seconds left, so I'm going to go quiet now. Hopefully, you guys don't forget to like the video, share the video, subscribe to the channel, get the word out there. We will have a look at the dot plots as you have requested, and yeah, we'll have a little comparison. But to be honest, you're going to see in the table anyway. So, but yeah, we can have a look at it if you want to. Alrighty. I'm going to go quiet now. Okay, good luck. Okay. So somehow the expectation then for the... Sorry, I'm just listening to James. Let me get the latest one here. Sorry, hold on, guys. Get it up. Here we are. Okay. I just come past it? Yeah, I did. Okay. Well, now. So, let's just make it a big screen. Let's move this out of the way. All right. So, lo and behold, anything above 5% would then provide a bearish reaction to the markets, which it did there from the initial move. It did. If we're looking at the rest of the market, it did whip back up. So let's see what else was said then by the central bank, if there was anything else. Okay. So yeah, so summary economic projections. So seeing it higher for this year and also higher in 2025 as well, but unchanged in 2026. Hopefully you guys can see that screen that I have there. I mean, if you can't, let me zoom in a bit more. Okay, so there we go. Okay. All right. How did everyone do? Are we doing all okay? And then if we go to... Okay, that's the current dot plot there then. And let's see what else we got for the previous dot plot. Where are we? Here we are. Okay. Here we go. All right. Let's bring this over here. I'll see if we can try and I should be able to put it on the same window. Let's close TICKSTRIKE for now so you can get a clearer idea. Zoom out a little bit. Okay. It's going to be a little hard to see, but okay. And then here is the last one. So you have the latest one here on the left-hand side, and we have the so the latest one here on the left-hand side, and the last one here. So yeah, so higher in the 2024 space were if you maybe had a couple of one member kind of stood out about 4, looks to be about 4.5 there, and the majority of members are looking at about 4.5 ish, 4.7, 4.6 there, around that area. And then here we've jumped around, done a Mario, and went up a bit to above 5% there to that area. Later on for 2024, 2025 we can look at later. 2024 is what's going to matter for yeah, 2024 is what's going to matter for you day traders. In the long term, sure, we can look at 2025. I mean, of course, I'm not saying don't, but 2024 is what's going to provide you with the expectation then. And let's see how we are in the markets. So just move that out of the way. Okay, it's a bit mixed, surprisingly. All right. So other than that, in the other areas, a slight, I mean, not really too much of a shift, as you can see, for the longer run or 2026. Maybe the only point, well, actually no, there has been, I take that back. So there has been that shift. You can see from out around that 2% area going towards the upper band and going into the 3% area towards 4%. 2025. So yeah, it's just a little bit higher, and more central bank members that are being a bit more hawkish than previously seen. All right, let's get out of that. And yeah, now there we go. Fed official median view of Fed funds rate at the end of 2024, 5.1% compared to 4.6. Okie dokie. Ladies and gents, well, thank you very much for joining me live. Hopefully you found that live stream useful, and if you, well, that concludes it. Basically, we're nearly there. We got the Bank of Japan this or Thursday night or Friday morning, if you're in the UK. So we're nearly there with the central banks. We're nearly done. But other than that, yeah, as I said, don't forget to like the video, share the video, subscribe to the channel, get the word out there about MACROACE. And if you found the information useful, then definitely, give us a shout out if you're running a live stream, or if you're doing your own explainer videos and stuff. Yeah, so definitely jump onto that bandwagon, and I will see you guys next week for the Bank of England interest rate decision. Okay, tomorrow I'll be looking at PPI. I won't cover in a live stream, but it'll be just added to the ranges and deviations sheet later on. Okay. Other than that, have a wonderful rest of day, and I will see you guys next Thursday. Okay, sayonara everyone. Take care. Bye. Sorry, just before I say goodbye, I know I said goodbye. can you ask the FJ group to give me access to TICKSTRIKE and unusual activity? I'm an affiliate. Can you send your email? I feel like we've spoken about this before for some reason, but just shoot over your email, because then we can get our marketing team to have a look. Right, send it to there. Have a little look. Okay, all right. Now I'm saying goodbye. Right, bye.